Hey guys, um, from my recent survey that some of you people are actually interested in watching if I posted a free lesson from my um, inner circle. Today I'll be sharing about interest rates, and if you are interested in investing in bonds, real estate, stocks, even crypto, interest rates are one of the most fundamental drivers of markets. So, in a macro sense or a big picture sense, learning about interest rates can help you learn when you should be going in the market and when would you start offloading your profits as well. So, when it comes to interest rates and how it affects the markets, it's actually one of the most single influential driving force behind market moves. And the reason why is because the interest rate is the amount a lender charges a borrower and is a percentage of the principal or the amount loan. So basically, it's the cost of borrowing money. So if it's easier to borrow money, um, people are more willing to like, loan for a car, a house, their business, whatever. And if it's um, higher to loan, they would rather save, right? And interest rates dictate that. And the people who govern the interest rates are what we call as central banks. So they're the ones that um, decide whether they would rather hike hike rates or they would cut them. So these central banks, for example, in the Philippines, that is your Bangko Sentral of the Philippines or BSP, and it's the Federal Reserve when it comes to the U.S. Um, more commonly known or called as the Fed. So the reason why I monitor or why I show mostly the US or the Fed policies are it's because smaller economies like us, the Philippines, we rely on the bigger economies on how they manage or how they hike rates or cut them in a sense. So that's why I closely monitor the Fed and their FOMC meetings on when they hike rates, when they're going to stop. It shows you signals or shows you potential reversals or buying opportunities or timing to sell your positions or your investment positions at a profit, right? So the Federal Reserve, along with other central banks around the world, so they use interest rates to as a monetary policy tool. So they use it by increasing the cost of borrowing money among commercial banks. Because when let's say, for example, a central bank would hike rates to 3.5%, the commercial banks will follow that their base interest rate would be 3.5% as well. And this affects many other interest rates like your loans, your personal loans, your business loans, and your mortgages as well. So if it makes borrowing more expensive in general, this lowers demand for money and it cools off a hot economy. So if an economy is going too fast, this poses a problem because it increases inflation. Because the law of supply and demand, there's less supply, more demand, prices go up, right? And then if there's more supply than demand, prices go down. So the federal so likewise when the central banks lower interest rates, this makes money more easier to borrow and it helps stimulate spending and investment as well. So this is the federal funds effective rate or the central bank's rate decisions over the years from 1998 to 2002. So as you can see, during the late 1990s, the interest rates were as high as 6.5%. But what happened here was there was a tech boom and bust cycle. So this affected the US economy and they went into a recession. So during a recession, the Fed did was they lowered interest rates to at least 1%. And then they slowly hiked rates again to 2007, 2008, where what happened was the global financial crisis of 2008, which did not just affect the US. So it started in the US, but it also affected everywhere in the world as well. So what the Fed did was that they cut rates to almost zero. So basically, your savings account has a 0% interest rates. The loans or the you can get is near or low 0% as well. So that's basically free money in a sense. Because let's say, for example, you loan 1 million pesos and your interest on that loan is 0%. And let's say you wanted to use that to make and sell siomai. So for this example sake, let's say um, it costs 10 pesos to make one piece of siomai and you sell it for 20. So your revenue is 2 million. And you just have to return the 1 million without interest to the bank and you've basically earned a million. So that's basically free money for businesses, right? So this stimulated the economy. So this stimulated spending for companies to expand their businesses as well, to stimulate the growth of the economy as well. But that doesn't mean there are actually implications when it comes to 0% interest rates, which I will discuss further on. So this is what happened as well during the COVID-19 pandemic during the March 2020 lockdown, right? So everyone stopped, the economy stopped, everyone stopped working because of the unknowns of the flu. And there was a sharp drop in GDP, and it was a really steep drop. I think it was like 16% for the US, around base averaging around 15% during the quarter one. Yeah, it was quarter one, March 2020. So what the Fed did was that they lowered interest rates from 1.75% immediately to zero. So as you can see, this is what affected how it was correlated with the markets. So as you can see, with high interest rates, what happens was there are demand destruction because people are less willing to spend. They would rather place their money in the bank because they would earn interest there. And this hurts investors as well in the stock market because why? People would rather sell their stock positions and place it in the bank because they have guaranteed interest compared to the stock market where returns aren't guaranteed. But every time that the Fed pivots to cutting the rates, so during 2002, they started cutting rates aggressively. And you can see that the stock market bottomed and it rallied away. During the 2008 crisis, um, when the banks started, going under, there was a lot of bank runs. Lehman Brothers effectively, how do I say this? They filed for bankruptcy. A lot of banks as well declared bankruptcy during that time. So when the Fed um, cut rates to zero, it also signaled a bottom in the stock market. And we had a bull run up to actually 2022. There was as you can see, during sharp or every time that the Fed decides to hike rates, there are implications in the markets like these corrections or these pullbacks where the market went down. And during what extreme rate hikes or high rate hikes, you can see that there are corrections. And then this is a special specific event because of the COVID. So the market crashed. And what the Fed did was they lowered again to 0%. And this helped the markets and the economy as well to rally. And then when the Fed started hiking rates, they hiked rates, the stock market and other assets also plummeted as well, as you can see in these charts. Show. So here's a chart of the S&P 500. So this is basically like a pooled the top 500 companies of the US. And during the pandemic, when the Fed decided to cut rates to 0%, the stock market rallied to as high as 113% from the bottom. From key specific stocks, like let's say, for example, Sea Limited. So Sea Limited basically owns Shopee and Garena, and as well as SeaMoney. So from the pandemic lows, it rallied as high as 950%. So that's like almost a 10x your money within a span of what, a year and a half. Tesla went as high as 1,300%. So that's 13 times your money. So for crypto specific asset, let's say for example, Ethereum. From the 2020 lows, went as high up as 3,373%, or a 33x your money in a span of what, a year, almost 2 years, right? So when we know that the reasoning behind this is because when interest rates are low, the cost of borrowing money is low. It's easier for people to, like I said, easier for people to borrow, easier for them to pay back, which allows them to spend. As well as, for example, if you place your money in the bank, it only earns what, 0.25%. So you would rather spend your money or purchase it in stocks, which gives you a better return on your capital, right? So this gives you capital for businesses, for them to spend and expand their businesses, governments for them to loan and improve the infrastructures of the country, for investors to speculate on the stock market, crypto, commodities, and also for personal consumption. So this also leads to capital flows into the market. And when people start buying assets, a lot of supply and demand, stock prices, asset prices go up. So this leads to the valuations expanding as well. So valuations become higher as well. As businesses earn more profit, their business becomes more valuable, which makes valuations go high as well. So um, the implications for lower rates though is that what happens is as demand increases and the supply stays the same, so this causes inflation because if there's less supply, prices tend to go up. So this is what happened in the past year, 2020, this 2022. A lot of prices soared, right? From the fuel, from 40, around 40 to as high as 90 pesos, right? Food became more expensive, real estate became more expensive, rent became more expensive. So that is a problem in itself. So what the Fed does is, what they do is they hike rates to cool off the economy. So you can see that when interest rates are zero, it tends to increase inflation, right? So what the Fed or the central banks do is that they use they use the interest rate to what mix let's just say mix and match to curb inflation and also the deflation as well. So when inflation becomes too high, what they do is they hike interest rates, because when they hike interest rates, there is slower economic growth that leads to lower inflation. And then when they cut interest rates, there's a higher economic growth and faster inflation. So interest rates really are a key factors when it comes to the markets. And I hope that this showed you how how do I say this? I hope this helps you when it comes to your investing and trading decisions as well. Although um, interest rates is not the only thing I monitor as well. There are other key factors that I look into before making a decision. Just because they hike rates and then they started lowering it doesn't mean I would go in already. So there are so much more things to learn, and if you guys want more content like this, please leave a like, and please subscribe to this YouTube channel. So it's very new. This is my first video, and I hope you guys have a great rest of your day.